Monthly dividends sound like a financial loophole. Get paid every 30 days just for holding shares. But here's what most videos skip. Chasing the highest headline yield is usually the fastest way to erode your principal. In 2026, smart income investors don't just look at the percentage. They look at sustainability, total return, and how the fund actually generates cash. Today, I'll show you exactly how monthly dividend ETFs work, why the 12% yield trap is real, and how to structure a $10,000 portfolio for reliable cash flow, not hype. Let's clear up a common myth. ETFs don't magically produce more money because they pay monthly. They collect dividends from the underlying companies they hold, then distribute them on a monthly calendar instead of quarterly. Same total payout, smoother budgeting. That's it. The real advantage isn't the frequency, it's compounding. If you enroll in a dividend reinvestment plan, those monthly payouts automatically buy more shares. Over time, you own more of the fund, which means larger future distributions. Monthly isn't a yield booster, it's a cash flow optimizer. Before you pick a ticker, run it through 3 filters. First, payout consistency. Has the fund maintained or grown its distributions through market downturns, or does it cut them when volatility hits? Second, expense ratio. Fees silently compound against you. A 1% fee can eat 20 to 30% of your long-term returns. Keep it lean. Third, underlying strategy. Is the fund holding profitable businesses, or is it heavily reliant on covered calls, return of capital, or high-leverage real estate? High yield often comes with hidden risk. Understanding the engine behind the payout is non-negotiable. Instead of ranking funds by yield, let's allocate based on purpose. I split a $10,000 starting portfolio into 3 buckets. Bucket 1. Core income. 50% or $5,000. Look at funds like JEPI or JEPQ. They blend large-cap equities with options strategies to generate roughly 7 to 9% in annualized distributions, paid monthly. They're built for income first, but they still track broad market trends. Expense ratios typically sit between 0.35 and 0.50%. Bucket 2. Global and sector diversification. 30% or $3,000. Funds like DIV or SDEM tap into higher-yielding international markets and real estate. Yields often run 8 to 10%, but you're taking on currency risk, geopolitical shifts, and higher volatility. This bucket amplifies income, but it shouldn't dominate your portfolio. Bucket 3. The quarterly to monthly bridge. 20% or $2,000. Here's a pro move. Most dividend growth ETFs pay quarterly. But if you stagger them, one paying in January, April, July, October, and another in February, May, August, November, you engineer your own monthly cash flow without sacrificing long-term appreciation. Funds like SCHD or DGRO fit here. Lower headline yield, but much stronger capital growth and dividend reliability. Let's run realistic numbers. A $10,000 portfolio, averaging a 7% distribution, pays about $700 a year. That's roughly $58 a month. It's not rent money. Not yet. But if you reinvest those payouts and add $200 a month from your income, you're looking at $300 to $400 in monthly passive income within 5 to 7 years. That's how wealth actually scales. Consistency and patience outperform yield chasing every single time. Before you invest, verify the distribution source. Is it net investment income, or is it return of capital? Return of capital isn't inherently bad, but it means you're getting part of your own money back, which reduces your cost basis and can create tax complications. Understand your tax bracket. Avoid allocating based on trailing 12-month yields alone, and rebalance annually. Markets shift. Strategies adapt. Your job is to stay disciplined, track your cost basis, and adjust as your goals evolve. If you want the exact spreadsheet I use to track monthly payouts, distribution sources, and tax implications, I've linked it below. And if you're ready to move from chasing yield to building real cash flow, watch this next video, where I break down 6 dividend stocks that actually cover a real housing budget in today's market. This is educational content, not financial advice. Do your own research, and I'll see you in the next one.